Yeah, well, I think what we got to start to see is we got to start to see enough of a decline in stocks to start making that trade-off between stocks and bonds make sense for investors. And when you're in a situation where bond yields are now in the 5 range, right? And earnings yields are in the 5 range, and there's a meaningful risk that you're not gonna meet those growth expectations that are priced into PEs, right? Right now, if you look at analyst earnings, they're expecting 12% earnings growth in 24 and then the same in 25. Like that's a lot of earnings growth
Yeah.
that is expected. Of course, analysts are always a little too rosy, but fine, forget it. Call it 10, call it 8. That's a lot of earnings growth in an environment where we're late cycle and bond yields just rose 100 basis points on the long end, right? Like, how are you going to get the economic growth that's going to be consistent with that sort of earnings growth in the future? And so that's really what has to happen is we got to start to normalize those expectations. We got to bring those PEs back to something that's much more reasonable relative to that 5% bond yield. And that's what creates the bottom in stock prices.
All right. Well, two questions then. Number one, I'm sure you have a macro outlook. So can you give us your macro outlook for, North America, if you will? And then secondarily, to normalize, what what price earnings ratio, what EPS are you think would be back to normal since it's been abnormal for 12 years?
Yeah, well, I think maybe starting with the second question,
Huh.
what does a normal bottoming look like in PEs, right? You've got to start to what do those situations typically look like? They look like 10, 12, 15 PEs. They look like typically when you've gone through a recession, you're looking at earnings compressing something like 15, 20% in a sort of non-crisis earnings drawdown. And so, what are we seeing here? Well, right now, what's priced in is earnings to go up 25%, not down, right? And we're seeing PEs, that are coming down every day at this pace, but still we're not quite in the range at the aggregate indices, right? At certainly small caps and mid
Sure.
caps are in the ballpark, but the mega caps are not, the S&P 500 is not close to where we are. So, if we get a couple points more down on PEs and we start to get those expectations of in line with actually some weakness in even zero, right? Even zero earnings growth over the next couple of years, moving those expectations down, that's when we start to talk about something that's a little more plausible. And so, moving the equity markets in this recession scenario, moving into the deep into the 3,000 range in the S&P 500 is totally
Yeah.
plausible. In fact, it should be expected.
Wow.